All right. Welcome, everybody, to the Tower Wealth Advisory podcast series. I'm Tyler.
I'm Dave.
And today we're talking about everything crypto. So we're very fortunate to have Brian Mosoff here, Chief Executive Officer over at Ether Capital with us. We also have Kevin Black, who is the Vice President of Sales of the Western Region for Purpose Investments here in Canada. We're going to be speaking to these two guys, and we're doing a bit of a different format this time. For those of you who have been involved in our webinars before, quite often there's a slide deck and a presentation, but we find with crypto, it's just a heck of a lot of questions, a lot of uncertainty out there, a lot of questions about the space. So we're going to have this as an open forum where our attendees can simply click on the question button down on the bottom of the Zoom tray, and you can ask your questions there, post them up. Dave and I can see those questions and we'll relay them to our speakers today. So please feel free to fire away with questions once we're done all of our introductions. So before we jump into questions, I'm going to first turn it over to Kevin over at Purpose so we can do a brief introduction of who Purpose Investments is, as well as who Brian is. Thanks, Kevin, for being here today.
Thanks, Dave. Thanks, Tyler. As Tyler mentioned, my name is Kevin Black. I'm the Vice President of Sales at Purpose Investments. I'm excited about today's session. Our guest speaker has been working in the crypto industry since its early beginnings. He's been actively involved with governments and private business discussing the application of cryptocurrency and blockchain technology. He was instrumental in assisting Purpose Investments and our offering of the first ever Bitcoin and Ether ETFs. He's my resource when I have questions that arise and have learned a great deal from him. So I hope you'll be able to say the same thing after today's session. So with that, I'd like to introduce Brian Mosoff. He's the Chief Executive Officer of Ether Capital, a leading public company focused on Ethereum and Web3 infrastructure. He's been involved in the cryptocurrency industry for over a decade and has acted as an advisor to both the Ontario Securities Commission and the Investment Industry Regulatory Organization of Canada regarding digital asset policy. Brian's also a founding member of the Canadian Web3 Council and a mentor to early blockchain startups at the Rotman School of Management's Creative Destruction Lab. So please welcome Brian. I'm going to turn the webinar back over to Dave and Tyler to engage in a fascinating discussion around crypto blockchain technology.
Perfect. Thanks, Kevin. Brian, thank you very much for spending time with us today. Before we really dive into crypto and everything that is crypto, maybe you could start the conversation by talking a bit about your history and how you got started in blockchain and cryptocurrency itself.
So hi, everyone, and thank you for having me here today. I'm always happy to chat anything crypto-related, Ethereum, Bitcoin. This is the world that I eat, sleep, and breathe and have for about a decade now. I think like most people in the space, they first hear about cryptocurrency or back when I came in 2012, it was really just Bitcoin back then. And a lot of people hear about it and go, I don't get it. Sounds insane. That can't possibly be a thing. And then they put it in a drawer and say, I don't really want to do any research. For me, it was helping a friend buy a used iPad off of Craigslist, where I first heard about Bitcoin. The gentleman was selling his house, his car for this asset, he called it, called Bitcoin. And I walked away with a friend thinking he was completely insane. Said, I've never heard of this. And I did some light clicking around, and this was probably late 2012, I think. Did some light clicking around on the internet of what Bitcoin exactly is, but again, thought it was too insane and didn't really get it. So I put it away. And then it continued to pop up on Reddit, a popular internet website, where you just couldn't ignore that it would continually hit the front page of this kind of news site. And so I did more investigation. Why is this a thing? And there was this very passionate community talking about monetary policy, talking about distributed computing science, and can you have a currency native to the internet? Should it be a currency? Is it a store of value? You know, what is this thing going to be? And I basically got sucked into the passion of that group of developers and people debating philosophically what digital money should be. And so I first really entered the space meaningfully in 2013, first through Bitcoin. People were taking that code and cloning it and calling it Litecoin, Dogecoin, Feathercoin. And it wasn't really until Ethereum comes about, and I have the benefit of being in Toronto, which is where Ethereum was born, where I thought that was really interesting, that there was a technical difference in a significant in a significant way between Bitcoin and Ethereum that I thought could give rise to all sorts of really interesting applications and use case. Even though I had no idea what they would be, I just thought it was really interesting from a technical standpoint. And so I started spending almost all of my time researching the space, looking at what would be competitive to it, how will it grow, how will it be adopted, what would the access points be, will it get regulated, will it not be? And that pretty much became my life. I joined Ether Capital in mid 2018. We are one of the first public companies focused on being an access point in the capital markets for the space, specifically focused around Ethereum ecosystem investments and infrastructure builds. And then throughout this work, I found myself, as Kevin mentioned, helping advise the Ontario Securities Commission and IROC, and now talking to a number of policymakers. What is this space going to be? Is it here to stay? What would appropriate frameworks look like to have it exist as an asset alongside traditional equities and integrate itself into the Canadian financial system? I've experienced many bear markets. There was a bear market in 2013. There was a bear market in 2014 to 2016-ish. And then there was a bear market that most people were aware of in that early 2018 until the second half of 2020. So I've watched this space be volatile. I've seen the price fluctuations. But the thing that I really want to stress to everyone here, and then I'm going to turn it back over to you guys, is I'm very focused on the developers and the communities and seeing that infrastructure continues to be built. That is what first drew me to the space. That's what interested me about the space. That is more important than day-to-day price fluctuations. To me, this is a thesis bet that in the next 5 years or 10 years, this is going to be a very important asset class. It will be an order of magnitude or more bigger than it is today. And that there's a lot of jobs and creativity and a wide design canvas available for people to create new tools and new forms of payment. And that to me is why I'm part of the space and really excited about it.
Well, that's great, because Dave and I were probably like the people you mentioned, where we read about it, heard about it, seen it, and just said, that's crazy, let's just put it aside. Now, that was a few years ago. We've become much more comfortable with it now as we gained understanding. And that's why we wanted to speak to you today, was so that we could kind of spread that understanding a bit. So you kind of loaded question, I guess, to start it off. And I'll just remind our viewers that this is an open forum. So please post your questions as they come to your mind, and we'll get them in front of Brian. But to maybe kick the conversation off, we can start very, very, at the ground level of what is crypto and blockchain, and can you explain the connection between the two?
So, Bitcoin is the first cryptocurrency. It arises in a white paper that I think hits the internet in October of 2008. The network goes live January 3, 2009. It's the first crypto asset. And what it's essentially trying to do is someone or a group of people are trying to replicate a monetary policy, but native to the internet. And they looked around the world and said, well, we think that gold is one of the best forms of money that exists, and it has some properties to it. The properties are, it needs to be extracted from the earth at kind of a predictable schedule. It has a fixed supply. There's kind of an upper bound on it, and people who are doing the work to extract it from the ground, get the asset. And so Bitcoin, I call a skeuomorphic asset, in that it is trying to replicate the properties of gold, but in a digital environment and be native to the internet. So Bitcoin has a lot of those same properties. It has a fixed supply. Only 21 million will ever exist. It gets created through something called proof of work, which is people running computing hardware and electricity, trying to secure transactions that take place on the network and create pages of the ledger, which are referred to as blocks. And this is where you get the term blockchain. And over time, the token gets distributed to a number of participants who are helping secure the network. Now, over time, what happens is people can replicate the code. This stuff is open source in that it's not created by a corporation, a government. It could be, but the assets that we think of in terms of a digital asset are open source code that live on websites like GitHub. They're repositories for code, and anyone can go and copy it. They can tweak around the recipe. They can redeploy it. And that's where you got Litecoin and Dogecoin. It was people who were taking the recipe of Bitcoin, this public code, and tweaking the recipe and redeploying it with a different brand. So blockchain is this term for that kind of network structure Some people try and separate blockchain from crypto. In kind of 2015, 2016, there was a lot of talk by corporations saying, can you have a blockchain without Bitcoin? Can you have a technology based on blockchain that's valuable, but strip away the native token? My view of this is you can't. The second that you don't have this problem with trust between two parties, you don't really need a blockchain. You could just use a database and have distributed participants contributing into the database. The thing that Bitcoin solved was having a global group of participants who don't know or trust one another come to consensus on the state of a ledger. That was the breakthrough in Bitcoin, was saying we can have this currency on the internet where no one's really in control and everyone's in control at the same time. The same as the internet. If you say, well, who owns the internet? It's like, well, everyone owns the internet, but kind of no one owns the internet. It's the same thing with crypto. And so my view is you can't separate blockchain and crypto. They go together. The purpose of these blockchains and these assets is to have unknown participants be able to come to consensus on the state of various activities at any point in time. And Bitcoin, I call a clearinghouse for one single asset, Bitcoin, and Ethereum is a clearinghouse for all sorts of assets and activities. And some of those assets and activities can be crypto native. It can be the token Ether. It can be an NFT, a piece of digital art. It can be a stable coin, a tokenized US dollar. Or maybe we're going to see people tokenize stocks and say this is a better clearinghouse than the current structure we have today. So that's kind of the difference between Bitcoin and Ethereum and why you can't quite separate blockchain and crypto.
There you go.
Good stuff. I think I got lots of questions, so I don't want to lead this down the wrong path, but I think of just what I understand from, say, Bitcoin, that it's never truly going to be a good transactional tool due to the nature of the open source of the technology, that you won't be able to stand in line with a Bitcoin Visa and you'll be there for 9 minutes holding up the grocery line while it clears. Whereas Ethereum is a bit more, it's open, but there's, proof of stake, and those will be the miners and things of that nature. So that allows for faster transactions, but potentially opens up, more, not, I wouldn't say a tax, but the trust factor of the whole structure. So, with that, I guess it brings one question first is, Bitcoin, what happens when 21 million are deployed? At this point, the miners, the way they make their money is mining and approving the ledger. So what happens when those are all used up? How will they get paid?
You opened a huge Pandora's box here of things that I'd like to comment on, and I'll try and keep them high level and short. The first is that when you tap on a Visa card, the transaction's actually not final. There is some risk that's being taken on where data centers only settle up with each other inside of the Visa network once a day, once every 8 hours, depending on where in the world it exists. When you mentioned that a Bitcoin transaction isn't settled or final until it's included in the next block for 9 or 10 minutes, that is true. I just wanted to point out that there's also risk when you use a Visa card that the transaction isn't actually settled or final yet. Now, in Bitcoin and Ether, you're right, the block times are different. Pages in the ledger for Bitcoin take place once every roughly 10 minutes. And in Ethereum, it's about every 15 seconds. So it's, of course, much faster to push a transaction through on Ethereum than it is on Bitcoin and consider it final. But there are ways to speed up these transactions into side networks, or what's called layer 2s on Ethereum. In Bitcoin, they use something called the Lightning Network. And what the Lightning Network does is allows people to lock up their Bitcoin and move on to this other network. And that network is essentially instant. When you send the Bitcoin from one address to another, or a fraction of a Bitcoin, it's on the network. Immediately, the transaction's taken place. It's not as secure as that base layer, as Bitcoin's base layer, but it essentially is an instant transaction. And you're seeing that technology deployed right now in El Salvador, in countries that are trying to use Bitcoin as a method of payment. I'm not sure that crypto, whether it's Ether or Bitcoin, are good currencies because of the volatility. They may be in other parts of the world and that they're more willing to adopt them for daily transactions, but not yet today. I actually got lost with what the original question was. I just wanted to make sure I got those 2 points in.
there, but it was what happens when the
right, the 21 million limit.
Yeah.
So for anyone who's not sure or wondering what the question is, the people who are performing validation on Bitcoin are rewarded in two ways. The first is that they receive the new Bitcoin that comes into existence for creating that next page of the ledger or the next block. And they also receive the transaction fees that took place during that 10-minute period, or 11-minute or 9-minute, depends on how fast the block was created. But that's how they're being rewarded. And baked into the software is this very predictable schedule of how much new Bitcoin is given out per block. And part of this monetary policy says that roughly every 4 years, that reward gets cut in half. And so it used to be that there were, on day one, 50 new Bitcoin per block. And then I guess it'd be 2013, there was a halving. I could be getting the years wrong, so no one jump at me if I'm getting them off by a year. But, roughly in that first 4-year period, the block reward gets cut down to 25, and then it goes to 12.5, and then 6.25. And over time, there's less and less being mined into existence up until we get to till we get to 21 million, which is roughly in the year 2140. And what they're asking is, what happens when we get to 21 million? What happens to the network then, and how will it be secure? And the Bitcoin community's answer to this is that the transaction fees will be so valuable because there will be so much demand to use this network that the compensation for validation is going to come by way of transaction fees. Now, that is the thesis that's part of the design of the Bitcoin white paper. There's a counter argument to that it may not be as secure long-term because maybe the transactions don't take place at Bitcoin's base layer and they take place on the Lightning Network. Or maybe Bitcoin gets tokenized and lives on Ethereum, something called wrapped Bitcoin. We don't know how this is going to play out, but it's certainly an area of hot debate and a lot of research is being put into it. But the thesis baked into that white paper is that the network is secured by the transaction fees and no longer the new Bitcoin being created. Oh, and I should point out that one of the reasons that Ethereum doesn't have a hard cap, people say, well, Ethereum doesn't have a hard cap like Bitcoin. There's no 21 million limit. That is by design, and it's because that community believes that you can't have a hard cap if you want to guarantee security. What you need is constant low inflation, meaning the people who are validating Ethereum, whether there's a lot of transactions that take place in a block or a page of the ledger, or there's not a lot of transactions taking place in a block or a page of the ledger, there's some guarantee, there's some way to incentivize the validator and compensate them for their work. And that is through this constant low inflation. Doesn't mean either of these communities are right or wrong, but that is how they are viewing the difference in monetary policies in these two networks.
So how many Bitcoin are out there right now? I've heard that there's 19 to 20 million already out there. Is that correct? Yeah. Hit the 21 million?
Yeah, I truthfully haven't looked at that number in probably 6 or plus months, but that number sounds correct to me. But we're currently at about 6.25 new Bitcoin per block. And in 2 more years, that will get cut in half again, right? So that new supply is mostly in circulation. Some of that circulating supply may have been lost. People who lost their password, their private keys, they put it on an old hard drive. Maybe you see a CNBC article where they talk about someone who now has $200 million sitting in a landfill somewhere and they're dumpster diving, hoping to find that hard drive. There's really no way to know what percentage of Bitcoin are lost to bad security or forgotten hard drives. But the total amount of Bitcoin that has been mined into existence is currently sub 20 million.
Okay. Kind of a curveball question on this is, especially for anybody who's new to this, there's definitely a sense of, well, this is crazy. Like I've got my currency, my government backs it. And now you're telling me that there's this virtual digital currency of Bitcoin or Ethereum or one of these. And, I hear people getting ripped off all the time or people losing, dumpster diving. I mean, there's people who've been dumpster diving for years for a shoebox that had, granny's money in it or whatever. So there's a lot of this. What would you, what's the comment here on people who don't think of this as an asset class and think it's somewhat of a joke's not right, but they're just very unsure and non-trusting of this?
Yeah, I think that we've seen over time more people become comfortable with the idea of software or algorithmic-based monetary policy. When you think about government currencies, they're also not hardened monetary policies. They're backed by, a central bank just deciding what the inflation schedule should be, what amount should be in circulation. They'll change the interest rates. They'll change how much printing goes on, and so there's no guarantees in how fiat basically will exist today, tomorrow, in 5 years from now, in 100 years from now. And it's also important to remember that there's never been a government issued currency that's lasted more than a couple hundred years. The US dollar, I always like to joke, is less old in its current form than the Rolling Stones. Meaning it's not tethered anymore to the gold standard. It's important to remind people of this. And one of the reasons people do like cryptocurrencies or are warming up to the idea is that for the first decade or so, kind of that 2009 birth of Bitcoin, up until the first half of 2020, where the COVID narrative kicked in, the people who were interested in cryptocurrencies were largely technologists, people who are a bit more internet native, more comfortable using the internet or software to do various things. And what happened was it was largely ignored by institutional investors or retail investors that couldn't find access points. They didn't really understand the narrative or why they should care. And what changed in kind of halfway through 2020 is as the narrative of COVID-19 started having people think about coming inflation, they started looking at what were the escape valves going to be. So gold is on the table. Is it going to be tech stocks? Is it going to be real estate? Well, maybe there's this new seat at the table of digital assets that have a very transparent monetary policy. It's very predictable. We know exactly how much new Bitcoin will be in circulation January 1, 2024. We don't know how many US dollars will be in circulation January 1, 2024. And so a new group of investors, the reason that this bull run is different, even though we're currently in a downward trend, but the difference of this bull run in crypto assets is that a new group of investors, I think, has woken up to this idea of software or algorithmic monetary policy and saying, maybe it's not such a crazy idea, and maybe it's worth 1% or 5% of a portfolio to have some exposure to this new asset class. One thing that I like to frame for investors is this idea that we've watched software disrupt a number of industries. And the two that I always point to is software disrupts the hotel industry by way of Airbnb in the early 2010s. And then you have Uber disrupting the taxi industry. And now what you're seeing is software disrupt monetary policy and central banking. It doesn't mean that it's going to replace them. It doesn't mean that it's going to take over the world tomorrow. But I think more and more people are growing comfortable with the asset class and the narrative surrounding it and saying, sure, I'll have some exposure to it. And another thing that I point out to new investors is, if you agree that more people are going to grow comfortable with it and that next generation, the people who are 20 years old today, who've grown up with, only knowing a world with the internet, they're more trusting of software, they're more trusting of applications. I mean, they also have some distrust towards, Big Brother and all that kind of stuff. But in general, they are more comfortable holding assets that we may think of as bizarre. And as that cohort becomes more dominant in the workforce, they may want to hold more assets that are untethered to a specific geopolitical agenda or a specific jurisdiction, and there'll be more interest in the asset class. So I don't get too caught up in day-to-day price. I'm not looking too much to convince people that they should go all in on crypto. I don't think they should. I think that it's important to just say, what is really happening here? Where is the asset class going to be a decade from now? Will more people want to be part of the space? Will there be better infrastructure surrounding the asset class? Will we have more custodians and insurance and audit firms? Is there intellectual capital coming into the space? If you think the answer is yes, and that trend will continue, then I think it's important not to write off the space. And the last point I'll make here is you mentioned scams and fraud. There's certainly a host of scams, theft, fraud across any of these assets, bad access points, bad exchanges, people pretending to run exchanges and stealing people's funds. And that's why I always caution people not to FOMO in, jump into some new flavor of the month token that they see in the news. Focus on the blue chip assets, the Bitcoins and the Ethereums. Do reading and homework. Why do those assets exist? What did they invent or change in the world. Peter Thiel has a book called 0 to 1, very famous Silicon Valley VC. And 0 to 1 talks about the invention of new technologies to displace something in the current system. And that if you want to displace a competitor, you can't just be an optimization. You need to be an order of magnitude better or different. Bitcoin invents a category. It is something that the world hadn't seen before. Ethereum invents a new category, this application layer, this application protocol for the internet. That is why I'm so focused on these assets, because they're 0 to 1s. They're not optimizations. These are 0 to 1s and inventions of new technologies and new categories. And so I think it's exciting to focus on the blue chips and why they exist. Say, should I have exposure in a portfolio? And be thoughtful about what the appropriate access point is going to be. Should you hold the assets on their own in a self-hosted wallet, software on your computer, inside of your browser, on your smartphone? Should you go onto a platform that may not be regulated in whatever jurisdiction you're in and buy your assets through them? Should you find a regulated platform and buy your assets through them? Or do you look to a structured product like an ETF or a closed fund? There's a spectrum for investors to participate in the asset class. And I think that's something that at Purpose, we're really excited about, is that investors who couldn't participate in the asset class in that 2009 to 2020 era, unless they were technologists and willing to take on the risk, now have exposure by a new set of access points, ETFs, closed funds. And so the more that people can participate, the better. They can take on a position in the asset class, knowing that the structured product abstracts away custody and all that kind of stuff. And that is one way to filter out fraud. And by the way, I'm not here to push people and say, buy an ETF or buy Bitcoin direct. I'm just illustrating that there's multiple access points. And it's just important to be thoughtful about ensuring that you're not part of fraud, hacks, and theft. And one way to do that is to ensure that you're focused on the right assets and then the right access point for what you're trying to achieve.
That's great. You covered a lot of good things there, and I think it leads to a couple questions. I'm going to jump backwards a little bit, but first of all, just a note: Kevin did look things up. It is 19 million of Bitcoin in circulation, and by halving continues until 2141. Until just kind of what you thought there. So just a confirmation for everyone. So I'm going to jump back halfway through your comments. The fact that these digitization of assets, whether it's currency or changing the taxi industry or the hosting or hotel industry, in this case, we're talking almost a monetary policy and currency. So this is an issue that's all Bank of Canada or the Fed in the States would have the sense that they might lose some of the tools that they have in their arsenal, fiscal and monetary policy, to manage the way the government manages things. Obviously, they're going to find a way to participate. Potentially, there is, some countries have banned things like Bitcoin, Ethereum, or any crypto. Is there going to be a place where they can all work together? And if so, why? And this is kind of the second part of the question, because this is, I always bring my dad up in these webinars because we have lots of discussions, and he doesn't seem to see in his mind why he would ever want to hold a Bitcoin. He can just use his Visa when he's in the States and he pays the current exchange and everything works just fine. So why would he have a Bitcoin? And I've battled a bit to try and explain it to him, but maybe how that ties together, why anybody would look at this as a class, as another form of holding it as an asset alongside the fiat currency, and how are the different governments going to overregulate this, underregulate it, or tie in their own digital currencies?
So it's important for your dad to kind of reframe the question. I mean, some people will use Bitcoin or crypto as a method of payment. People who live in other countries that have far more volatile currencies or eroded trust in their local currencies. He's right. He lives in Canada. He doesn't really see the need to pay through Bitcoin. It's a pretty clunky way to pay for something. But someone who's leaving Ukraine right now, who can't get access to their bank account, 12 or 24 word password that would let them access their net worth and access it in another jurisdiction, that's a pretty powerful tool to them. People who've held the Turkish lira over the last 24 months have basically watched their life savings be eroded. People in Argentina, where the Argentinian peso used to be 1-to-1 to the US dollar, they don't ask why Bitcoin, they ask how Bitcoin, because the idea of having an untethered monetary policy to their current regime is something that's very important. And the people who are opting into Bitcoin currently are not doing it mostly because they are looking to pay for their groceries or their coffee when they go out. They're looking to opt out of the monetary policy of their central bank. And whether they're right or wrong to do that, whether the asset goes up or down and it's speculation, I'm not really here to convince anyone of anything. I'm just pointing out why people are looking at the asset in a different way. And that there's, again, a spectrum of investors. There's people who are saying, this is better than my local currency in the part of the world that I'm in. And then there's people who are comfortable with their local currencies and saying, I just want some type of hedge against the monetary policy of my jurisdiction, and I'll speculate on the asset. How are governments going to look at it? I think I'm involved in a number of conversations with policymakers currently, central bankers, on how they should be thinking about the asset class. I've not really heard any of them say, we're looking at how we can ban it. And that is, I think that they're aware that they're not going to be successful at an outright ban. You've seen Venezuela attempt to ban the asset class, didn't work so well. India tried to ban the asset class, didn't work so well. China tried to ban all the Bitcoin mining. It immediately moved to the US. The network didn't go down. And it shows how resilient the network is. And important for people to recognize that if you push it out of your jurisdiction, that's fine. But understand that there's always going to be some type of regulatory arbitrage, and the activity is not going to go away just because the US doesn't like it, or Japan doesn't like it, or China doesn't like it. It's just going to continue on in other parts of the world that want to welcome it. And there's always going to be some countries, some state, some province that sees an opportunity to lean into a new technology. And so the government conversations that I've had are not about banning and pushing it away. It's, how do we make this work and compliant in our current frameworks, or do we have to adjust the frameworks and be creative on what the access points should be and what would be appropriate for retail investors versus accredited investors? It's very complicated as you get into DeFi and you get into NFTs and the metaverse, and the line becomes blurrier between what the assets are. The asset is very easy to define with Bitcoin. We can say it's a commodity and here's how it works and here's who controls the network and who doesn't. And then you go further down the rabbit hole and some of these other assets may look more like a security, or maybe it starts as a security and then turns into a commodity over time. And that hasn't been defined yet. So it's really tricky for policymakers to figure out what's going to be appropriate for the asset class. I think you're right in that guaranteeing sovereignty is something very important for Canada. It's something that I'm very in favor of, and I've had a number of discussions again with a number of MPs and people on what are we going to need to do to ensure that that happens. And one of the things that I point out is in the next decade, as we look to modernizing payments, digitizing currencies, in terms of a Canadian dollar, you can either think of this as what's called a stable coin, a tokenized Canadian dollar, or a central bank digital currency, a CBDC. I think what's important to understand is it doesn't necessarily matter what the politicians and the central bank wants to do. Let's look at what's realistically going to be true in 10 years from now. Will more people be more comfortable paying, not with just a Visa plastic credit card, but will the payment happen through something like a cell phone or an Apple Watch? I'm not wearing an Apple Watch. This is an old watch, but you could pretend for those who are watching this video that I'm wearing an Apple Watch. If more people get comfortable using these as a way to pay, and that next generation grows up comfortable with a diverse set of assets, what's likely going to happen here is they're not just going to hold digital Canadian dollars on their Apple Watch, or whatever Android watch they have. If they're on Team Apple, Team Google, I don't know. They are going to say, sure, I'm going to hold some digital Canadian dollars, and I'm going to have my Visa that exists on the watch, but maybe I also hold tokenized US dollars. And maybe I hold some NFTs. And maybe I have fractionalized NFTs. And maybe I hold some Bitcoin and I hold some Ether. My prediction is that in 10 years from now, that next generation is going to be more comfortable holding a number of things in their wallet. And today, we hold multiple debit cards, multiple Visa cards, and some of those Visa cards could be issued by Visa, they could be MasterCard. So we already are a world that is comfortable having multiple bank accounts and multiple ways of paying. And that next generation is going to have a different set of assets. And as the exchanges get bigger and more liquid, and there's more price discovery on those assets, and you could figure out what a price of a fractionalized NFT is, it may seem bizarre to us today or on this call, but my guess is that that next generation is going to be far more fluid in how they pay for things. And their allegiance to a digital Canadian dollar may not be as strong as we have today. And what's really important for Bank of Canada and anyone in Canada who's thinking about what is the future going to be of cryptocurrencies blended with tokenized Canadian dollars or whatever flavor they come in, we have to ensure to get sovereignty that we're thoughtful about how these two worlds are going to coexist. And my view on this is that the way to guarantee that a Canadian dollar retains interest is to find a way to actually integrate it into crypto, and that it can be something that you can use as a tool for innovation inside of decentralized finance and all of the really exciting activity that's taking place in the crypto world. And the US, despite them being frustrated, of course, by crypto and the speculation and fraud and not knowing how to regulate the exchanges, one thing that's really interesting that's happened in the last couple of years, and that is most of all of the activity that takes place in crypto is denominated in US dollars. And there are literally hundreds of billions of tokenized US dollars, referred to as stable coins, that exist now on these blockchains. And the reason that this is interesting is the US has actually almost guaranteed the extension of the life of their currency by becoming the de facto quote currency in crypto. When you trade on a decentralized exchange, when you purchase an NFT, these things are all priced in tokenized US dollars. And so as much as it's tricky right now to figure out who should be able to issue the tokenized US dollars, is it going to be a deposit taking institution? What type of registrations would be required? Transparency, checklist. The reality is they have an opportunity that they can lean into. And for Canada, I see the same thing, that one way to guarantee that the Canadian dollar is something valuable in 10 years is to find a way to integrate it into that world, to have hundreds of billions of dollars that float around these blockchains that are part of the innovation and all of the really exciting activity. Canadian dollars in terms of reserves globally right now is sub 3%. It'd be a great benchmark to say, can we get 2 to 3% of crypto native activity to be denominated in some form of tokenized Canadian dollar? And so I think the takeaway here is, in this next decade, we have to think about the Canadian dollar not just in silo of what the Bank of Canada wants to do, what the monetary policy should be, if it plugs into open banking, if a CBDC gets created by the central bank, or if this is something that the central bank does in collaboration with the commercial banks. All I think that matters is ensuring that innovation can exist on top of whatever they build, whatever technology and framework they put in place. We have to make sure that it can be innovated on top of in this new open, decentralized world, and that there's interest globally in our currency. And marrying those two things is not going to be easy, but I think it is the only thing that we can do. And I'm lending a lot of my time and expertise and research efforts into talking to anyone who's involved in those types of conversations, because I think we have to be thoughtful about getting this right and understanding that there's multiple dials that we can optimize for here. There's the AML and KYC dial and sanctions, that dial and compliance. And then there's another dial around innovation. And they're almost inversely correlated in a way that as you turn up the dial on one, you're turning down the dial on the other. And I'm not here, by the way, to say you should just go maximum on innovation and get rid of regulation and oversight. I'm just trying to point out we have to be thoughtful that these two dials exist and we can optimize for one of the two or both at the same time. But let's be very thoughtful and measured in our approach of how we do this.
A lot of good information there, and obviously lots of things to be worked on to make things integrate better, to get obviously regulation involved, to the concept of just having a phone with multiple different pieces inside. I think that makes a lot of sense. We're pretty much there for what everybody's used to, which is your bank account and your multiple credit cards. There's just other assets that can be there through crypto and stable coins and things like that. So that's great.
I had a question for you, Brian, and it's stuff that we've read, and maybe you can speak to it, is just a bit about the blockchain, how it is the backbone to these cryptocurrencies, but that it's used in different ways. And blockchain really essentially, by my understanding, and this is really dumbing it down, is it's basically just a ledger.
Mm-hmm.
to confirm the transaction has happened and that it's happened, honestly and truthfully, and it's started from end to finish, and everybody's rewarded the way they need it to be. So we've learned a bit about NFTs, non-fungible tokens. Can you speak a little bit about NFTs? So some of our clients have maybe heard of people buying sports cards, but really they're just images, pieces of art that are images, and these NFTs are using blockchain as a way to transact. Can you maybe elaborate on how this is used and how it sets up?
So you're 100% right that a blockchain is essentially just a database that's distributed to a number of participants. And in the crypto world, it's using a token to underpin the validation and confirmation of transactions and recording all that activity into a page of the ledger or a block. I do push back a little bit on you can't have a blockchain that's really that valuable without a crypto native token in there. That's kind of just a distributed database, and we already have those. A lot of people who are excited about supply chain and how can we use blockchain in supply chain to track the growth of something or how much water was used or to guarantee authenticity of a certain item. I mean, those are all good things. I like the spirit of that. I just don't know that you need a blockchain to do that. A MySQL database would be just fine. In terms of NFTs, an NFT, for anyone who's not familiar, stands for non-fungible token. And it basically is, in its first form, a representation of some form of art. So money is fungible, right? I hand you a $5 bill or a different $5 bill. You don't really care which $5 bill I gave you. It's the same thing. Although technically there's probably a serial number on the bills and you would care, and one had a tear in it. So it's not truly fungible, but in general, it's fungible. Money is fungible. When you think about real estate or a piece of art, you want a token that represents a very specific thing. Not a house just somewhere in Canada. No, you want the token that represents a house on this street that I specifically paid for, and that's what the token represents. And we saw an explosion of interest in NFTs in that second half of 2020, largely a big part of the crypto narrative in 2021, and NFT and the metaverse are all tied together. And this is people looking at mostly digital native art that lives on a blockchain, and most of it took place on Ethereum. And some of the assets would have extremely high valuations and seem crazy. Some of it, there's a new group of investors who think that long-term, some of these could be the next, Jean-Michel Basquiat. Who knows? I think something really interesting will come from NFTs and the metaverse, but I think it's very early. And I caution investors not to speculate on, again, the new flavor of the month, the new thing that pops up, and to focus on the blue chip protocols. And we're not sure which vertical long-term is going to have the most value. Is it going to be NFTs? Is it going to be the metaverse? Is it going to be decentralized finance? Is it going to be stable coin payments, right? Tokenized US dollars or tokenized dollars or euros or yen that live on a blockchain? No one really knows. What we can say for sure is that there's a lot of demand to use these global settlement layers. And the biggest global settlement layer is Ethereum, which is why I'm so excited by it. And a lot of that really exciting NFT activity took place on Ethereum. So NFTs can be this tool to rally communities around a certain set of aesthetics. So maybe people mint 5,000 pieces of art with a certain aesthetic and try and build a community around a brand or around a set of characters or, a set of squiggly lines. Who knows? But it's very early days. It is highly speculative. And I would imagine that most of the NFTs that were minted over the last 24 months won't be around or relevant or have any type of price discovery or market or secondary market in 5 years from now. And I liken this to the 2017 ICO boom. And in 2017, you had people issuing tokens on Ethereum. ICO stands for Initial Coin Offering. And in 2017, people were issuing tokens, basically, probably illegal securities, on Ethereum saying, we're going to one day create decentralized Dropbox, or we're going to do decentralized cloud computing, or maybe we're going to make a prediction market based on a blockchain. And some of the things were fraud and scammy, and then some of them had really good intention, and there was some real technical development there. And they used the token to try and incentivize and rally a community around their project. The reason I'm mentioning this is that if you look at a snapshot of the top 10 assets by market cap in 2017, go to, I don't know, November of 2017, that were not Bitcoin or Ethereum, what were the next 10 on that list? And then we pull up in 2022, that same list, we've still got Bitcoin and Ethereum at the top. Are those top 10 things the assets that emerged from all of that hype, that big ICO boom? The answer is no. In fact, I'm almost certain none of them are even in the top 20 at this point in time. And so I kind of likened this to what's happening right now in the NFT and the metaverse boom, in that none of the things that got minted in the last year or so, I imagine will be the big dominant players of NFT and metaverse narratives in 5 years from now. So I think that those verticals will be around and be very important, but I don't think that the specific assets will necessarily play out the way investors hope. And which is why I'm so focused on that base layer to say, I don't want to speculate on verticals. I just want to speculate on there's going to be demand to use a blockchain for all sorts of activity, but I don't want to have to pick which specific activity is going to be the winner.
So, I mean, developing on that, technically, you can pretty much tokenize anything. We talked with a couple of weeks ago with Dr. James Thorne from Wellington, and one of his comments was, imagine Wayne Gretzky starting right now, and we just tokenized Wayne Gretzky, and he basically sold himself to, 1 million tokens, and you would receive your share of his lifetime earnings from everything. And that kind of is baffling to a lot of people to think that you can tokenize something like that. But essentially, stock in a company is a tokenization of the value of that company. So it's just it's a digitization of it, and it's a different exchange, as you said. Can it be done in a more efficient way? Can it clear throughout the world instead of having, one specific exchange that everything has to go through? So I think it's quite interesting that things can go that way. I'm going to roll into another question we've got from some people that are watching. And basically, I think I'll develop on this a bit, but it's, if you're already holding cryptocurrency, and obviously you can sell some of it and make a profit, you can sell some of it and lose handily. It's just depends on what you bought it for and what you sell it for. But before you'd mentioned the different ways to hold it. And I think, there's different exchanges, there's different way to transact on it. And there's, hot wallet, cold wallets, all of those. For somebody who's just interested in getting into these investments without a lot of complication, what's the most efficient way?
I think that the easiest way probably is through a structured product where they don't have to worry about custody. If they're simply looking to have price exposure to the asset, then a structured product like a closed fund or an ETF is the most appropriate way. It's the easiest, it's the cleanest, it's tax efficient. It looks like a traditional equity. For an investor who wants to learn about the asset and touch the technology themselves, they can download a wallet, a piece of software. They can go out and buy a hardware wallet, which is basically a USB stick. I'm holding one right now. It's called a Ledger. There's a number of companies who manufacture them. And they can take on the risk and experience of touching the asset themselves. And there's a lot to be learned from doing that. I don't ever say to anyone who's curious not to do it, but to be thoughtful about how much money they're looking to deploy into the space and in what time frame. The learning curve is quite steep. And so for someone who says, I wanted to put X number of dollars into the space because I just believe in it and want to hold it and have exposure to the asset class, maybe what they want to do is buy most of it through a structured product for now, but then go and buy, $50 or $100 worth of Bitcoin or Ether and have it in their own wallet just to see how it works, how they can move the asset between two different accounts. Maybe they want to go into DeFi and see how lending or trading works on these decentralized exchanges. But get the education while you're playing with a small amount of money and understand that these are digital bearer assets. There's no undo button here. There's no one to call if you lose your password, if you lose your device. The responsibility and onus is on that end user to have an appropriate backup, a second copy. Maybe it's outside of their house because, in case something happens to your house, you want to know that you have a backup. So again, it's really about being thoughtful about where on the barbell is appropriate for what you're trying to do. And so I don't encourage people to go in I don't push people in any one specific direction. I just try and push them to be thoughtful and to do research before they dive in headfirst with significant money. Certainly, the ETFs are the easiest way to access the asset class, and the upside of the ETFs, again, is that there's institution grade custody and procedures involved, audit firms making sure that the controls on who can access the crypto and monitoring who makes the request to trade, buy, sell are appropriate. You may not have that same set of controls on even a regulated exchange. I think that the regulated exchanges platforms are getting better over time. They're certainly much better than they were in 2013 and 2014 and 15 when I first entered the space, but there's still just different risks to those platforms. There's no true one-to-one insurance on these assets in the space. It's not possible to say, I'll buy $1 billion of Bitcoin and have it one-to-one insured. That would cost an obscene amount of money, so no one does it. So you're really reliant on working with good partners on where you're going to purchase the assets through, how they're going to custody those assets. And if you're going to custody it on your own, ensuring that the software you downloaded, the hardware wallet you bought is from an above board group of people, that there's transparency, maybe there's some history there, maybe there's some documentation on the internet of known people in the space who believe that that's a good access point or a way to hold the asset. But even then, you still don't know. I mean, there's a lot of people who thought certain pieces of code that live on these blockchains has been battle tested enough and secure. And then you read a few months later that there's a hack where there's some theft and some funds were lost. It is still very much a new asset class. It is a highly technical asset class, and we're still scratching the surface on what best practice are going to be. And that's why, again, I keep saying, stick to the blue chips, the Bitcoin and the Ethers, because there's enough eyes on those assets. There's enough people working on these hard problems around custody and access points for those two blue chips, different than people who want to get exposure to the higher risk, newer flavor of the month. Those best practices may not exist yet. The infrastructure and the tooling may not be as advanced. So it might be harder to hold, I don't know, the new coin that has a dog or a cat on it. Maybe you went out and bought yourself a little USB key wallet, and then you find out, new coin with dog, not supported by your new device. So again, research really is paramount, and reaching out to people who are experts in the space and trying to pick their brain and get advice is really important. And just be thoughtful about how you wade into the asset class and what the access point should be and how you would custody or hold on to the asset long term.
That's great. I think that kind of warrants a comment that we tell most of our clients now, especially with the proliferation of digital assets. It's one thing that where your key is, where your wallet is, or the passwords. If something were to happen to you and you pass away, if somebody doesn't have the keys or the logins, you're pretty much in trouble. So, we're seeing written into wills now that you are listing digital assets as something that is passed on, and somebody has the right to access those. Companies like Facebook and all of these won't let your executor walk into your Facebook account to get all the photos you might have. You need to have these things listed properly so that you are passing them on to your beneficiaries. I think people have to be really aware that they need a repository somewhere with a pretty locked up master password on all of their different passwords, and share that with whoever their executor of their will might be, because when you go, those assets go with it. And at the same thing, the more assets you have spread around different networks, exchanges, advisors, you have to settle with each one of those institutions, and each one of those transactions costs money and takes time. So I think if you're just looking to dabble into this, it's potentially a small amount in a wallet that nobody will miss if it's gone, just to get the flavor of it, like you said. And then secondly, something that's quite managed for you that you can buy and sell on a daily basis without worrying about. That's part of your overall account that settles with your account.
Absolutely.
Great. You got another question? We got one more up here on that.
You can go ahead and go to the viewers' questions.
The question is, what would a central bank look at for cryptocurrency with the verification of assets by miners? It seems like counterfeiting would be eliminated. What other pros are there? Is there any downside?
I'm not sure what the specific question is. I do think, as I was mentioning before, that central banks are going to look at creating their own cryptocurrencies or their own digitization of the Canadian dollar, the US dollar, and they're trying to figure out what exactly that would look like. Would that be based on a blockchain? Do they need a blockchain? Can they just do it without a blockchain? Do they involve the commercial banks? Do they not involve the commercial banks? There's no answers to these things yet. There's a number of research papers taking place by universities, by thought leaders. It's still very early days. I think in the next few years, you'll see different projects testing out what a CBDC will look like. China has a test pilot program happening right now with their CBDC. They have to ask questions like, will their digital Canadian dollar plug into an open network like Ethereum? No one knows, but these are conversations to be had. Certainly, the opportunity to have more oversight into transaction flow would exist if currencies became more digital or more optimized, but that also raises questions around privacy and what's appropriate in terms of oversight and compliance for how those dollars would flow around. Are they going to mimic cash, or are they going to mimic Visa transactions where there's this flow of funds that anyone can see? And we would like to believe that it's only a good government or police who are acting in good faith when times are appropriate to have purview into a certain set of transactions. But as payments become more modernized and digitized and exist in these databases, who has access to those databases? What checks and balances will there be on those systems? And what checks and balances will there be to ensure that not just our country has access to the database? What about foreign entities that want to access that database and see the flow of funds, to see what citizens are doing and use that information for blackmail, for extortion, for hacking the database to change the monetary policy? These are all things that a lot of people are thinking about. Again, it's still very early days. I'm involved in a number of conversations around this topic. I find it really fascinating. I find it really exhausting. But I think it's important to have these discussions and be thoughtful and measured about how we are going to create the next form of currency. I don't think people are going to be walking around with paper bills in their pocket 1,000 years from now. So when people say, should we just not do this and just keep currency as it is today? My answer is, listen, maybe that lasts for a few more years, maybe it lasts 10 more years, maybe it lasts 50 years. But I don't think in 1,000 years, we're still walking around with paper in a pocket. And we're probably not walking around. We're probably some cyborg somewhere. But, if we do believe that at some point things become more digital, then we should start thinking today about what is the best framework for creating those dollars, who would have access. Is it a central bank? Is it a commercial bank? All of these things are on the table right now and being discussed, but no one knows the timeline. We don't know if this is 2 years away or 5 years away or 10 years away, but it's something that a lot of people are thinking about and talking about, and the pros and cons.
Well, it does feel exciting. It feels, like you're in on the ground floor of something that's, a change, a monumental change in how we've worked and ran our economies in the past. So it's exciting stuff, Brian. And we have hit our hour that we set aside for you today. So we wanted to take an opportunity here to thank you for joining us and sharing your insights around this topic with us. I don't know if it's made it more confusing or better understood by our viewers, but we'll be questions after, and anybody can always reach out to us if they have further questions, and Dave and I can forward those questions on through Kevin and yourself, Brian. So again, thank you very much for being here, and we'll sign off for now.
Thank you guys for having me, and hope to see you soon.